Verification and valuation of general assets and liabilities. Difference between verification and valuation of assets. So in this lecture, we will see what is verification, what is valuation of assets, who does valuation, what is the expectation out of this exercise. Verification of assets implies an inquiry into the title, ownership and value of assets, its existence and possession, and the fact whether any charges exist on the assets. Verification, if not done properly by the auditor may be held liable. It is also done to make sure that auditing is free of any charges. Valuation of assets and liabilities is part of verification. It may include critical examination and assessments of determining the value of assets. Valuation of assets is not the duty of the auditor. An expert valuer will fulfill the valuation of assets and may issue a certificate on that regard. Hence, an auditor will not be held liable for incorrect valuation of assets. Next, we will take a look at classification of assets and liabilities. What provides benefit to a business and what forms part of economic resources is termed as an asset. The main characteristics of an asset is that it results from prior event or transactions. It is controlled by an entity and it provides a future economic benefits. So general assets may be classified into tangible assets, intangible assets, fixed assets, current assets, wasting assets, fictitious assets and contingent assets. General liability may be classified as current or short-term liability, long-term liability and contingent liabilities. Now we will take a look at what are the general assets and the different classifications of them. Assets may be classified as tangible assets and intangible assets. Assets which can be touched or felt and have physical appearance is tangible, for example, cash or machinery. Assets having no physical appearance is intangible, and examples are patent or trademark. Fixed assets are capital assets that is held for a long time and is not generally brought in for reselling purposes. Examples of fixed assets are land and buildings, plant and machinery, furniture and fixtures, etc. Current assets. Current assets are assets having a lifespan of 1 year or more or that lasts until the normal business operations if it is more than a year. Examples of current assets are bank balance, prepaid expenses, bills receivable, stock, marketable securities, cash, etc. Now let us see what are wasting assets. Wasting assets are assets which are depleted gradually or have reached the end of their maximum life cycle due to continuous extraction. Examples are mines, quarry, oil rig, etc. Wasting assets are depleted because of continuous extraction or use of assets, whereas fixed assets are depreciated. There is a difference between depletion and depreciation. Depletion means it will be continuously extracted until the asset is no more. Whereas depreciated means fixed assets are depreciated because of long use and may get obsolete or may acquire a residual value at the end of its life. Fictitious assets. Let us see what is now fictitious asset. Fictitious assets are assets on which money spent on them are unreasonable and the assets by themselves are not physically visible. Examples are preliminary expenses for the formation of a company. So that is what is fictitious assets. Next, we will see what is contingent assets. Contingent assets are assets that depend its existence on some future event that may or may not happen. Examples may be a successful lawsuit claiming damages of another party. Possibility is always on the term being successful. Next, we will take what liabilities. What are the classifications of liabilities? Liabilities refer to the amounts which a business owes to outside people. They may be current or short term, which is then called current liability, long term, which is then called long term liability, and contingent liability. We'll see what each of them are. So current liability includes all obligations falling due or imminent within an year or within the operating cycle of a business, whichever is lesser. Examples may be bills payable, bank overdraft, accrued expenses payable, sundry creditors, etc. Long-term liabilities are obligations that may be payable in goods or services or money after a period of more than 1 year. So the difference between current liability and long-term liability. Current liability is always short-term, maybe within an year. So examples may be bills payable or bank overdraft, which may not be there for more than a year. Whereas long-term liability are obligations that may be payable in goods or services or money after a period of more than 1 year. Examples may be term loans payable, any long-term loans taken, debenture issues of a company, which may be payable by a company after the tenor fixed for the debenture issue, which may run for 10 to 15 years, which is a long-term liability. Next, we'll see what is contingent liability. Contingent liabilities are liabilities which is a future debt based on past action or on a future action. However, there is no actual liability for a determinable amount within the balance sheet period. So normally contingent liabilities are not recorded in the book of accounts, but a reference to the effect is made in the footnotes in the balance sheet of a company. So in the balance sheet, in the footnotes section, if you actually see, contingent liabilities will be recorded. Contingent liabilities may be belonging to two different classes, namely secondary obligations and direct financial obligation. In secondary obligations, liability may exist unless a primary obliging party fails in the liquidation of the liability. So unless a primary obliging party fails in the liquidation of the liability, it becomes a secondary obligation. In direct financial obligation, these obligations may not be settled. Examples may be litigations involving patent claims, claims and guarantees of products, etc. So in summary, hence, if verification of assets implies an inquiry into the title, ownership and value of assets, valuation entails examination and assessment of assets to determine its value. So that is the difference between verification of assets and valuation of assets. So this completes verification and valuation of general assets and liabilities. Thank you.